Howdy, Team 42. It's your skipper here, Darius to present our macro minute for Monday, July 21st, 2025. Hope everyone had a wonderful weekend. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So, today's key macro questions are: how is Q2 earnings season shaping up thus far? And what is the key risk of Japan's LDP losing its 7-decade stranglehold on Japanese parliament? Our answers: Q2 earnings season kicked off strong last week as the banks crushed expectations and multiple airlines signaled resilient travel demand, forcing bears into the upside capitulation we've been calling for since May 3rd. This is all consistent with our 3-year-old resilient U.S. economy theme and our 3-month-old paradigm C theme. Both themes call for both macro and micro data to continue generally surprising to the upside over the medium to long term, which is 3 to 12 plus months in our risk management nomenclature. With 60 companies having reported thus far, S&P 500 constituents are reporting modestly decelerating sales growth to 4.4%, down from 5% in Q1, and the highest percentage of positive surprises since 1Q 2023 at 66.1%. S&P 500 constituents are reporting a material deceleration in earnings growth to 3.3%, down from 13.6% in Q1, and also the highest percentage of positive surprises since 2Q21 at 83.1%. Despite losing control of both parliamentary chambers for the first time in the Liberal Democratic Party's 70-year history, Japanese Prime Minister Shigeru Ishiba vowed to stay in power Monday. In a twist of political irony, Ishiba, who called for then Prime Minister Shinzo Abe's resignation in 2007, was reminded Monday of his past demand that Abe, quote unquote, explain himself to the public as well as to the party. 18 years later, the LDP carousel spins once again with Ishiba in the hot seat and needing to score political wins to maintain power. Ishiba seeks, quote unquote, tangible results from U.S. trade talks and dispatched longtime Deputy Rizoye Akazawa to Washington for an 8th round of negotiations. Ishiba's desperation may cause him to misjudge the Trump administration's willingness to soften terms in trade negotiations, which may ultimately result in higher tariffs and increased trade policy uncertainty over a short-term time horizon, which is less than 1 month in our risk management nomenclature. Transitioning to our 42 macro dashboard, as always, to wrap up the question from our community. This one starts, hello, Skipper. I'm not quite sure where I can ask your question, but I was listening to Tuesday's macro minute, and you've reiterated numerous times, and rightfully so, about paradigm C. However, you overlay the idea that the Federal Reserve should be taking into account information and cutting the Fed funds rate, and I just don't understand that at all. Exactly why, with unemployment at around 4% and economic growth running at around 2%, plus financial conditions, according to my weekly update from the Chicago Federal Reserve Board, have done nothing but loosen for months and months on end, and the rapid speculation in the stock market at an all-time high, exactly why should the Federal Reserve be cutting short-term interest rates? 40 years of investing tells me anything, maybe they should be increasing short-term interest rates. So, we just have a different take on that in our view. Just with regards to the unemployment rate, recall that we had a significant change in immigration policy at the start of the year with the incoming Trump administration. Essentially locked down the border. If you look at legal border crossings, which are tracking kind of in the 250,000 per month range, we're now tracking kind of in the less than 20,000 per month range. And I want to say the most recent month of data, which I believe is June, we saw essentially almost no illegal border crossings. And now we're obviously starting to see some deportations as well. So all that reduction in the growth rate of labor supply, if not outright negative, outright contraction in labor supply, is keeping it's depressing the unemployment rate. So the unemployment rate right now, and will be increasingly so as we move forward in time with this same tighter immigration enforcement policy, is going to be artificially depressed relative to what it otherwise would be in the context of the degradation and softening we continue to observe in the labor market. I would say the most important statistic from the June jobs report that we got a few weeks ago was the fact that private sector labor income growth slowed to 1.4% on a 3-month annualized rate of change basis. That 1.4% is 390 basis points lower than the pre-COVID trend of private sector labor income growth. That 370 basis point deceleration from 5.1% 3-month annualized to 1.4% 3-month annualized in June was the sharpest deceleration since May of 2022. And that 1.4% 3-month annualized growth rate in private sector labor income was the lowest level we've seen since June of 2020. since the lockdowns of June of 2020. And so we had a significant and sharp deceleration in private sector labor income growth, again, sharpest deceleration we've seen since May of 2022 to the lowest level we've seen since June of 2020, tells you that there was we're already starting to see a very clear evidence of our U-shaped economy theme in the labor market. So in our view, it does behoove the Fed to actually get on with it because I think they're making what I think is a very flawed, and I think what a lot of strategists, economists, and investors view as a flawed argument that, hey, we got to wait and see on tariffs to see if they're going to be inflationary or not. We know tariffs aren't inflationary. There's legions of academic literature that says tariffs are one-time price level change. They're one-off shock to the general price level. This is not inflation. The Fed's policy rate has nothing to do. It's not going to be able to impact tariff inflation at all. This one-off price level change to the upside or downside. So the Fed should ignore the impact of tariffs and just look at what the underlying inflation trends, inflation data are suggesting, and more importantly, what the underlying macroeconomic data is suggesting as it relates to the outlook for the labor market. I mean, the June data tells you that the labor market is as bad as it's been in Delta terms since May of 2022 when we had a technical recession, and since June of 2020 when we had an actual recession, at least with the lockdowns in COVID. So that's, in our opinion, I think the Fed would do well to start to lower the policy rate again. But again, we've been of the view for years that the most important thing that the Fed needs to do in this fourth turning regime is to support fiscal balance. And so I think by the end of this fourth turning, we have a very high conviction belief that the Federal Reserve's principal mandate will be supporting the Treasury market functioning, more so than maintaining stable prices and more so than maintaining maximum employment. We think those will become less important as drivers of Fed policy than the functioning in the Treasury market. And so if we, kind of skating to where the puck's going to be, none of this really matters. What really matters is, okay, where is Fed policy going to go from a structural perspective? We talked about that ad nauseum. We've been talking about that ad nauseum for years now in the context of our investing, doing a fourth turning regime analysis, which perfectly prepared our clients, 42 macro clients, for the very wider range of the wider distribution, rather, of economic and policy outcomes that we continue to observe from a fiscal and monetary and ultimately asset price response perspective here in this fourth turning regime. And obviously, in our view, the fourth turning has got materially accelerated here in 2025. So I think when you think about Fed policy, we can talk about inflation, we can talk about growth in the labor market, but ultimately where we're headed, if you want to finish the race before all the other investors, where we're headed is the Treasury is going to LBO the Fed, and ultimately the Fed's going to be used as a tool to support Treasury market functioning, because that's how these things always end. That's paradigm D. That's the print phase. Right now we're in paradigm C, which is the growth phase, and courtesy of some fantastic research from yours truly, there's investors all over the world benefiting from our paradigm C theme, and in our view, we think they're going to be benefiting from our paradigm C theme on a trend basis, at least through the midterm elections next year. So really happy to have beat Wall Street yet again to a very material theme. Really grateful for our clients for partnering with us to participate in the persistent and consistent front running of Wall Street to these important themes in global financial markets. And don't expect that's going to end anytime soon, Lord willing. So we'll wrap it up there. Darius here presenting our macro minute for Monday, July 21st, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.